Right, good afternoon, everyone. This is Charles Kelly again with you for Money Tips Podcast. Today, I've got a very special guest who's Josh Saul, the founder and CEO of the Pure Gold Company. Now, Josh was previously an analyst researching markets and opportunities in the city for large investment houses, and he first became interested in precious metals. Now, he often appears as a well-informed commentator on such channels as, and he talks about gold and silver and buying in bullion or buying in coins. But he's appeared on CNBC, BBC, and a host of other newspapers and podcasts and on YouTube. And he's got quite a large following in this. And I became interested in Josh because I think he gives a good overview of gold and silver. He gives an impartial view of things as well. He's not just saying, well, you can only invest in gold and silver. I've used the company actually myself, and I found that they've got a very good system where you can actually talk to somebody, talk to a human being about what you want to do. So Josh has a company called the Pure Gold Company. It provides a really good service to people on precious metals, gold and silver. They've got storage facilities as well. They've got 15 years experience in the market, and he clearly understands the importance of personalization when it comes to investment decisions. So I'll hand over to Josh in a second, but welcome, Josh. Welcome to the podcast. Great to have you here.
Thanks for having me, Charles.
Right. And a lot of our viewers and listeners are quite interested in what's going on with gold, because you hear a lot about gold. There's a lot of stuff going on in the market. You hear, we've got high inflation, we've got, governments in debts and the dollar and this sort of thing. And you hear about all these things and nations, buying a lot of gold, central banks. But in your opinion, what is this thing about gold? Why is it there's such a buzz about gold at the moment? And why should we be looking at gold as part of our investment portfolio?
Well, I was on Bloomberg last week, and
Wow.
I was asked by a journalist the exact question. And in fact, the question keeps on coming up.
Yeah.
In the face of so much uncertainty and volatility and unpredictability, what do we do with our wealth? What do we do with our investments? Do we act? Do we react? Do we be proactive? And it's a really good question, because in the 15 years I've been doing this, I've never seen as many well-talented and skilled people ask the very same question. And there's no real one answer. But since you ask, it's certainly worth talking about how I answered that, because it was a live segment on Bloomberg. And so, I went on to explain, how the wealthy, the smart money, the professionals protect, preserve, and grow wealth during times of uncertainty without paying any tax whatsoever. So it's normally at the point in which I mention tax or HMRC that I tend to get people's attention. So what I'm going to do is I'm going to share my screen so you can see some slides that I've presented. It just provides a little bit of a visual cue to prop me in terms of what I'm talking about.
Great, I can see that. And I understand there's been quite record demand in 2023. So you seem to be very busy at the moment.
Well, yeah, we've seen a 93% increase in gold demand this 93%. Year compared to the last year, and that's been reflected across central banks as well. We saw 1,183 tons purchased through central banks all over the world last year, which was the single largest amount of gold that we've seen purchased in any year since records began. So there's clearly good reason for doing it. And I guess my goal right now is to explain, why you would do it, why you wouldn't do it, and I guess the alternatives to physical gold, because it's impossible to look at anything in isolation. You shouldn't do, because everything's relative. I aim to talk about equities and property and cryptocurrency, bonds, leaving your money in the bank. I'll go into enough detail to whet people's appetite. And then I'll provide some information in terms of being able to find out more if your clients or the people that follow you have that inclination.
That's great.
So a little bit about me before I start. can you see what I'm saying? Can you see my screen?
Yeah, so 15 years in the precious metals investment market.
Perfect. So this is me. It is true. I have, I guess, more than 15 years of experience within the precious metals market. I started my career in the legal world. I trained as a solicitor in the banking and capital markets. I then moved on to become an analyst at a company called FTI Consulting. And my role there was to analyze companies, sectors, and markets relative to one another. It's quite interesting. We would sell on research to the likes of KPMG, and then KPMG would then sell that into the likes of the Financial Times as their own research.
Okay.
And that's what gave me not only a close proximity to physical gold as an asset class, but the firm I was working for was responsible for handling the collapse of Lehman Brothers and General Motors. So on the one hand, I got to see the nuances of financial ruin, but I also got to see the trend and the correlation between how assets reacted to that, in particular physical gold.
Okay.
And so that took me further into physical gold as a career and as an asset class. And I kind of delved further into granular detail in terms of how gold could protect people during times of uncertainty and also provide insurance during times, when things are good. And so I set up the Pure Gold Company, and I set this up in 2012. And we specialize in providing physical gold, physical silver, coins or bars by delivery or storage. We're fortunate enough to have a really good reputation. And the reason for that is we're one of the only companies that apply a consultative approach when talking to our clients. And what that means is we get to not only do we talk to every one of our clients, but we get to understand why they're doing what they're doing. So we get to understand the motivations for why they want to do what they're doing.
Yeah.
We give guidance in terms of why they should do it, why they shouldn't do it, how to do it, when to do it. So there'll be times where we would suggest to kind of consider waiting to make a purchase if we believed that there was an opportunity in the gold price via waiting, and also quite the converse. If we think more can be gained by acting sooner, both in terms of removing exposure and also picking up price gains, then we may well suggest to move sooner. And so with a lot of that information that we acquire from clients in terms of underlying motivations for why they purchase, we have real qualitative, colorful data that we provide back to the press. Clearly, in a very private, anonymous way, but we're able to give those trends, as they're happening, as opposed to once they've happened. And so we've been featured on the likes of CNBC, Money Week, BBC. We were on GMTV a few weeks ago, and as I said before, I was on Bloomberg last week. And so I'm very proud of the reputation that we've earned over, the years that we've been in business. It's all about me. All you can see is pictures of me.
Okay.
So going back to the question that I probably confused everyone with when we first started this conversation, in the face of so much uncertainty, volatility, fear, what does one do with their wealth? As I said before, it's a commonly asked question, not just from the media, not just from the banks, not just from the smart money or the ultra high net worth individuals, but I would say that most of the people that we speak to at the moment, however financially savvy they are, this is the question they tend to ask. So it's the question that I think is worth answering. And I get it. The UK has had an embarrassment of riches, from having 5 prime ministers in a really short period of time to seeing, record high inflation relative to earnings. And then, of course, the potential for a debt crisis. We've had various experts kind of paint a very glum picture moving forward. And so I get it. When you start to look at the alternatives in terms of, what to invest in, how to do it, it's not a foregone conclusion. There doesn't seem to be any kind of low-hanging fruit. I would also say that we haven't seen inflation at these levels for quite a few years.
Yeah.
And when inflation, we hear of reports of 9% and 10%, and whichever metric you choose to believe, at the very least, it sits at around 6% as we speak. But we've also got to take into account the fact that, energy costs are 400% higher. So if we take into account everything, I would reasonably say that inflation probably sits at around 8 or 9%. And so I believe that puts a lot of pressure on people to do things with their money, right? Whereas 2 or 3 years ago, when inflation was very, very low, that pressure might not have been as strong as it is at the moment. That pressure can lead to wealth destruction through making the wrong decisions purely from ticking a box and saying, at least I've done it. At least I've got my money working for me. But it's only working for you, if it's protected, preserved, and stands a chance of increasing. Otherwise, what you end up doing is you end up investing in a reward-free risk. This is something that Dr. John Hussman articulated. He's a fund manager. And he said that, when you look at asset classes at the moment, you're looking at reward-free risks, taking on risk for little reward.
Can I also say about inflation that, the Chancellor is saying, we're getting inflation under control and this sort of thing, but it doesn't seem to be going away. It's gone up in the Eurozone and in Germany in particular. So I'm not sure if inflation is actually really under control. And as you say, the real inflation, the food inflation and the energy costs are, they've tweaked these inflation figures over the years. So I don't think we're out of the woods. And, a lot of people are still nervous about things. And it's a question of navigating your way through this jungle of problems. And inflation, of course, is eating away at people's money. I know people have got hundreds of thousands in the bank where the bank didn't even put the rate up when rates were going up. They were leaving that. They said, no, that account, we haven't changed that account. I went down with her, an old lady, and she, I said, well, just move your money. But she said, no, I want to keep it there. I know where it is. And that's the apathy that a lot of investors have. Anyway, I'll let you carry. Sorry if there's a bit of noise here. There's a bit of drilling going on upstairs. I don't know what, I thought they'd finished this morning, but
I can't hear it at all.
Okay, great.
I couldn't agree more. I'm going to try and avoid getting into the granular detail of inflation because I could be here all day. But, suffice to say, I know of lots of people and clients that operate within the food industry. They have restaurants, they have supply chain businesses, and inflation for certain foods have increased by 50 or 60% to the point where people that have kind of a narrow menu of things that they sell, they've gone out of business because there's no way they can pass on a 50% increase to their customers without going out of business.
Correct.
And so you're correct. The measure that they use for inflation is completely arbitrary. But if we take into account a best case scenario and make our case based on that, then, I feel like at least we're comparing, the reality of the situation with a best case scenario for inflation.
Okay.
And there's been so much stuff that's happened over the last 12 to 24 months. Of course, we saw Silicon Valley Bank collapse, the beginning of one of the biggest scams and lack of liquidity crisis within cryptocurrency. But at the same time, we've seen, share values in Credit Suisse and Metro Bank fall by 30%. We've seen businesses on the high street close at record pace.
Yep.
And so I get why it's confusing out there, because it is, what does one do? I think the only real certainty in today's market is uncertainty. And actually, uncertainty is kind of represented in whole by black swan events, the unknown unknowns. And, whether or not we're talking about Brexit or COVID or the pumping of money into the money supply as a result of COVID, and then the furlough schemes and what have you, these are all things that no one could have predicted. You've got equity corrections and property corrections. This within reason, people can predict, give or take a few years, because the markets are cyclical. We know that, we understand it. But these sorts of things that never happened before, you can't predict. But what we're now starting to appreciate is that we can anticipate them, because they're now starting to happen with increasing frequency. We don't know what's going to happen, but we do know that over the next 18 months or so, there'll probably be another black swan. If we go back, we rewind kind of a couple of years ago, we had Russia, we had Ukraine, then we had what's going on in the Middle East. These are all things, again, that we couldn't have really predicted, but we're now starting to anticipate that every 12 to 18 months, there's something that comes along that we couldn't have predicted. And actually, in a way, that provides us with a degree of certainty in a very, very uncertain world.
Yeah.
Whenever we talk to clients, we don't just talk about gold. In fact, the majority of what we talk about is the wide spectrum of alternatives available within the market. Because as I said before, Charles, I don't think it's possible to just look at one asset class in isolation. I think everything's relative. And as a person, as opposed to just a company that sells physical gold, I have equities. I've invested in bonds. I've had buy-to-lets before. So in a way, I'm also an investor. And, if we go back and you look at 2008, you look at 1980, you look at the dot-com crash, these are times where the wealthy get a lot wealthier. And so I get how the future looks grim and uncertain, but actually it's not all bad. There is huge amounts of opportunity during uncertainty and volatility. The question is knowing what that opportunity looks like and being able to quantify it in terms of timing. Because as I'm sure you can agree, a great opportunity might not be so great, if you apply the wrong timing.
Correct. Yeah.
So timing, I think, is absolutely critical. But I think, as I said before, when I'm talking to my clients, we start with the alternatives. And so, when we look at equities, for example, I see huge amounts of opportunity in the equity market in probably 2 to 3 years' time. I don't want to get too overly technical, but what I will say with equities is that there's a gentleman called Michael Berry. They made a film about him. The film was called The Big Short. And if anyone hasn't seen that film, I'd strongly suggest to see it, because it breaks down the intricacies of the market in such simplistic language that actually, you'll start to think that you can understand everything. And actually, in reality, it's possible, if you strip out all the jargon. In this film, and it's based on real life, it's based on a true story. Yeah. Michael Berry was a small minority of the market that believed that we were going to see a big crash. And as a result of that, he was betting or buying insurance products for very cheap, because no one else was buying them, that the market would collapse. And today he has one of the largest funds within the market as a result of getting that right. The reason I mention that is because he has just placed 1.23 billion against the same thing happening, either within the debt market or the equity market. And so, lots of people have opinions, lots of people have predictions, but I think it's quite rare that you have people that back it up with their own money. Just because he's got it right before doesn't mean that he's going to get it right again. But, he's put down 1.23 billion that, he thinks this is going to happen. And actually, because of his reputation, a lot of people are now starting to listen to what, he says. But it's not just that. If you're looking at equities, the way in which you value a company, one of the metrics is the price to earnings, which is the price of a share relative to a company's earnings or future earnings. And as society has advanced and technology has become more sophisticated, the gap between the value of a company and how much it earns has become really, really wide. For some people, if you were to talk to a stockbroker, 50 years ago, it would be completely absurd to them how you could have a company whose share price was really high, but actually the company made no money, right? It's all based on future earnings. So when Amazon first came out, it wasn't making any money, but the share price was high based on future potential earnings. And so the reason I'm mentioning that is that when you see a huge disconnect between the value of a share and its earnings, what you face is the potential for a market crash. Whenever we've seen the S&P 500 breach 30 times price to earnings over the last 75 years, we've seen a market crash from anywhere in between 20% to 50%. This has happened on 5 occasions. On every single one of those occasions, the market breached 30. At the moment, we're at 33.
This is what a lot of people call a PE ratio, which for some companies is very high. It's an enormous PE ratio, whereas the old-fashioned brokers might say, well, a PE ratio of 10 to 20 is good. But some of these companies that you see in the top companies have huge PE ratios at 30, 40, 50.
100%. And actually, the global median is 15. So right now, we're more than twice the global median. So if you were to use those stats and you were to project, where you would be with the S&P 500, if you were to invest today for the next 10 years, it gives a figure of around minus 4.2%. If you take into account the adjusted cyclical inflation figures. Anyway, I don't want to get too technical, but what I wanted to do was just back up why I believe that equities will be, an unbelievable opportunity. But I think that if you were to jump in right now because you think there may well be a deal, all things are relative. I believe that there may well be a lot more opportunity in 2 or 3 years' time when things have really bottled out.
You think it would take that long before things bottom out, even if there were a crash this year?
I don't know. I think, timing is really difficult because the globalization of information has become so accessible that I believe that these sorts of trends are likely to happen a lot quicker than they ever have done. Okay. People are able to act and react a lot quicker than they would have done, 20 or 30 years ago. So it depends. When you're looking at the debt market, which is highly relevant to bonds, interest rates have gone up. People are, as a result, really worried about their mortgage payments, but that hasn't yet affected everyone. And so it might not affect people probably for another 2 or 3 years when they're coming off their fixed rate products.
Yeah.
And so for me, that's the reason why it may well be slightly prolonged, just because people feel it at different pinch points. But if we talk about, if we're talking about bonds, because bonds right now, they're paying more than they were a few years ago. And so they have to be an obvious contender. Some would see putting money into government bonds as a low risk strategy, lower return if you're putting it within a gilt or a government institution. But you're locking it up. And, if you are earning kind of 4 or 5%, you're locking up your money into a guaranteed loss to inflation product. And so if we are motivated to come across that opportunity, it might be a property, it might be an equity, it might be, crypto, or it might be something that you hadn't even anticipated. Having your money in a fixed term bond will remove some of that agility. You're not going to be able to act quickly. But the other side of things is that putting it in a government bond may well be relatively safer than putting it in a corporate bond. Now, corporate bonds, the way we see it, is they're paying a lot more, but they're paying more because they reflect a lot more risk.
Higher risk.
And, the worry for me with corporate bonds is that as interest rates have increased to its peak, they've now started to plateau. The cost of a company's debt has increased. So if we see companies like, for example, Pizza Express, Domino's, they want to raise money on the bond market. They're having to pay, as of maybe last year, maybe 7% in order to attract investors to invest in one of these companies. But because the cost of that debt is so high, and because people are now spending a lot less money because they're worried about inflation and there needs to be some sort of a compromise, the money that these businesses are taking in terms of spend is decreasing. But their overheads are increasing because the cost of debt is increasing. And this therefore affects profit. And so looking at it in really simplistic terms, it puts companies in a far more precarious position than we've seen them in, for decades, because of the margins between how much they're making and what their outgoings are.
Yeah, the debt has brought down companies that have been trading very well. Your photo showed Woolworths. I believe Woolworths had a good trading record, but it was brought down by its debt. And we see Evergrande, this large Chinese property company, defaulting on bonds, on their bond commitments. So yeah, I mean, your money is tied up in a bond, but you can sell a bond, you can sell it on, but the value of that bond can go up or down. So it's not purely risk-free in that respect. But I think a lot of people would not understand bonds and would probably not buy bonds directly. But we know that pension funds use them because there's a guarantee there. It locks in a guarantee to meet their commitments. But it's I think in a lot of people's mind, it's a bit of a grey area. But it does, I think, as you know, it will predict what may be happening in the market with the bond rates and how bonds are performing.
Yeah, I agree. I also agree that it's become a complicated area of the market where there are more people that see the risk than they do the reward.
Right.
And so, again, if we're looking at other alternatives within the market, one may well consider that the banks right now are paying more than they have done over the last 10 years in with some savings accounts, depending on who they are, some of them are paying up to 4%.
Yeah.
And so I believe you've got more flexibility with a savings account than you do a bond because there's nothing to sell. Effectively, you can just take your money out of the bank, and so you have got more flexibility. I would say that the trade-off, though, is that you're going to get less interest with a savings account than you would do a bond. So your loss to inflation is higher. But the other thing that would be remiss of me not to mention, and I would say it's the number one motivator at the moment for people wanting to take money out of the bank, is counterparty risk, i.e. the risk that banks may well fail. And that might seem really distant or arbitrary or abstract, but we've seen it before. We saw it with Northern Rock, we saw it with Lehman Brothers, and Meredith Whitney, who predicted the crash back in 2008, she believes that we are going to see a considerable consolidation within the banking industry. When she uses the word consolidation, what I hear is we're going to see a lot. We're going to end up with a lot less banks than we see at the moment, which means that some of them are going to disappear. And maybe that's a good thing. I'm not going to comment either way, but we've seen share price in Metro drop by 30%. We've seen share price in Credit Suisse also fall considerably. And so, moving back to opportunities, would it be an opportunity to buy a bank stock today? Possibly. Would the market continue to fall? Likely. Would there be opportunity in a year or 2 years' time? In my opinion, highly likely. And so there's opportunity there. But at the same time, when people are putting money into a bank and they know that they're not covered for anything beyond 85,000, if that bank goes under, you have to say goodbye to anything that you leave with them over and above the 85,000. And this goes back to the saying before when I said this kind of amounts to nothing more than a reward-free risk. You're risking everything for no reward. You're losing to inflation, but yet you've got counterparty risk. And so this is a really important factor. We've also got clients that are skeptical as to whether or not the money under 85,000 would be covered if we saw a situation where more than 2 or 3 banks were to collapse. Let's face it, the deposit protection scheme is academic at best. We hope it will never be tested because we know that in order for the free market economy to survive, it needs to have confidence. And so without a guarantee, no one's going to put money in banks. And if no one puts money in banks, then the system collapses. And so they have to say that it's guaranteed or covered, because without it, there wouldn't be a system. Whether or not that would step in to cover you is another issue. But moreover, removing the speculation, because one will never know, and hopefully we'll never find out. What I can say, what I think is probably more realistic, is in a situation where you've got money in a high street bank and a bank unfortunately goes under, we don't know how long it's going to take for us to be able to access that money. It may well be 4 weeks, it might be 4 months, it might be 8 months. And the problem with that is that we've all got things that we need to pay for, right? We've got to pay for mortgages, we have to pay for survival and living. And that kind of raises the potential of a significant cash flow issue within people's kind of daily lives. When you've got a cash flow issue with business, they may well be making lots and lots of money, but if their cash flow is disaligned, they can go bankrupt just because it's not coming in quick enough for them to pay out their obligations.
Yeah.
So that's a consideration.
Yeah, I think most people know that if everybody went to the bank and took their money out, that the bank haven't got it. They've lent that money out. And when you deposit money with a bank, you're an unsecured creditor. And we've seen more than one bank go down in America. And quite a few banks are at risk at the moment from the amount of commercial loans that they've got on things like offices which are unoccupied, and you've got large property companies in trouble. So there are some risks with banks. But what we don't know is if there was a run on banks and a few of them went down, would the government, rather than bail out these banks, would they bail in? And would you end up with maybe shares in those banks rather than cash? That's an unknown factor. But as you said, it's something that you hope you never use, like a nuclear deterrent. You hope that they never have to do this. But I would say that when banks have got into trouble in the UK, they've usually been taken over by another bank. So we haven't had a situation, well, as far as in my memory, where a bank has literally gone under and people have lost all their money. So hopefully there'll be more of a consolidation, as you said, of the banks into fewer banks, and people won't lose all of their savings. But you should be aware that you're only covered up to £85,000, and you should spread your money around. That would be the normal advice.
Yeah, and I would also say, look, these risks are minimized if you're keeping money in banks short term. That risk generally is minimized, if you're keeping money in a bank short term. And you're always going to have money in bank accounts to pay, overheads, obligations, and commitments. So moving on to crypto, which is an asset class that I would say is not for the faint-hearted. A lot of people have speculated within cryptocurrency, far more people than I would say actually understand it. I've seen people that have made money. I've seen a lot more people that have lost a lot of money. And so cryptocurrency, in terms of blockchain, unbelievable technology, certainly here for the long term. Although I don't believe cryptocurrency should be looked at as a store of wealth, as it was first communicated, 10 or 15 years ago, just because you haven't got that track record. The volatility is huge. We've seen situations where people have lost 80 or 90%, overnight. We've also seen people that have gone from 100% down to zero. Our clients if they're deciding to take a risk with cryptocurrency, it's more a question of how much can I afford to lose, and they'll spread that across, various different coins. I wouldn't say that's a bad idea at all, but I think you need to go in with your eyes open, manage your own expectations, and understand that there's a reasonable chance of loss. There's a minimal chance of huge growth. The chance is there, far more than winning the lottery, but to some extent, it is a punt.
It's not only people that are invested in cryptocurrencies, it's funds and hedge funds. And they've launched an ETF in America. They've approved an ETF for cryptocurrency. And if you talk to a cryptocurrency buff, they are 100% convinced that this is the thing, that this is going to go up to hundreds of thousands, the Bitcoin's going to go up to hundreds of thousands, if not millions, and that the rest of the currencies are going to collapse and it's all doom and gloom. But I don't know. I don't know enough about it to invest. I'd personally rather have a gold coin in my hand than a notional Bitcoin. Is it a currency even? Can you really use that as a currency? I don't think so.
Look, I understand that crypto is in a way a currency, and it's used as one. I just see that you hear of a lot of these success stories where people have made kind of 30,000%, but do they ever get out at the right time? No, for two reasons. First of all, once you started to find a really quick and easy way to make money, you don't stop doing it until you end up losing that money. And number two, it becomes really difficult to exit the market when you want to exit the market, because it's an immature market. There's not a huge amount of track record. And so one has to look at it with their eyes open. I think that the issue with cryptocurrency is that it's grabbed so much media attention that you get people that think, I earn £3,000 a month. I've heard and I've read stories of people basically becoming multi-millionaires from putting in as little as a couple of £1,000s into coins. And actually, this is going to answer all my dreams and prayers. And you get people that put in that money into crypto and, they could lose 80% overnight. Could go up by 100%, but it can also drop by 100% too.
Yeah, a lot of it's FOMO, isn't it? They're worried about losing out, and but it could be another South Sea bubble or the Dutch tulip bubble. We don't know. I mean, maybe I'm wrong, but anyway, you've covered crypto. I think you've given a good explanation of crypto.
Yeah, the other thing as well, I saw a really great documentary the other day about cryptocurrency, and it said that actually over the last 5 years or so, 75% of cryptocurrencies that were ICO'd were scams. Wow. And so they are created in really disguised ways where it's almost impossible to determine if something is real or if it's not. SVB was a big example of that. The documentary that I saw the other day was one called Bitcond, where the market really believed that they were investing in this technology within cryptocurrency, and because it's so unregulated, it turned out that actually the technology didn't exist. The people and the founders didn't really have any background and didn't have the background they said they had. And actually the whole thing was just smokes and mirrors. And, when that was discovered, basically everything went to zero and the founders ended up in jail, but people lost their livelihoods.
Yeah.
Anyway, we move on. Property is an interesting one, because this is one asset class that I really do get behind. Property is fungible. It's income generating. It provokes emotion. We love the look of property. If we're buying one for ourselves, one can fall in love with it. And so property, in my opinion, will never fall to zero. It's a tangible asset class. It's worth its cost in bricks and mortar. But, there's a time and there's a place. During the 1980s, the wealthy became very wealthy from acquiring property that people were selling because, those people that were selling could not afford to live in those properties anymore. Yeah,
mortgages went, I remember when mortgages were 16%.
Yes.
Yeah, right.
16%, 17%. Back then, I think the difference between then and now is that people have a lot higher debt. They have a lot more debt in relation to their income. And so I guess it's just a question of, what your mortgage payments were and what they will be. And so a 400% increase in anything is eye-watering. People will either react to that when it happens, and if they do, they'll end up on the back foot because they're going to have to undersell their property to get funds in quick enough to be able to avoid foreclosure and other negative implications, or people will plan for it. But either way, I can't see a situation where people aren't making decisions to either downsize, move property, reduce debt in order to reduce their exposure to an increase in debt. And the only way they could do that is pay down mortgage, which I think is just really difficult to do unless you sell your property. But what that does mean is that I believe there's a lot of opportunity in the property market. If one can be patient enough to wait to pick up those opportunities, I believe that real value can be acquired. And I think it's a question of, I was saying this the other day to one of my clients. Value is price is what you pay for a property, and value is what you get. The wealthy invest based on value, not based on price. And so they're influenced very, very differently when looking at asset classes. Everyday people that are pressurized by inflation to do something, almost anything, they end up buying and mistiming opportunities, which then creates, wealth destruction. Whereas the wealthy can sit there patiently, bide their time, wait for those opportunities, because they're not influenced by the same pressures.
Yes, correct.
So unfortunately, this kind of brings us full circle back to where we started in terms of, what on earth do we do? If we accept the fact that, these are all these are all asset classes that have their time and their place, but we accept that actually there's more to lose than there is to gain from investing in them right now.
Yeah.
What do we do? And so there are two solutions that I see as viable in terms of limiting risk, but maximizing reward. Before I go on to that, it's worth talking about what the smart money are doing, because effectively we take our cue from what the professionals do, not necessarily what they're saying,